be talking about a very important topic as it relates to options trading. It's a topic that I've run into myself. I've had some experience with, unfortunately, but it was a good learning experience, and it's, kind of one of those things that I want to put out there so other people don't have to go through the same experience as I do. Luckily it only happened to me once, and so I was able to kind of get like grace from my broker on it. And this is essentially, I think if anybody is an options trader, they know exactly what I'm talking about. This is essentially the pattern day trader rule, right? Now the pattern day trader rule, what is that? Well, essentially, if you have less than what your broker requires to have a margin account, so for me, TD Ameritrade, it's $25,000 in my account that you're trading options in, or anything really. This doesn't have to just be with options, but generally this is where you see it happen. It can be with stocks as well. So if you have less than $25,000 in your account and you make 4, or whatever your broker is, some brokers might say 3, some brokers might say 5, it's just a certain number of what's called round trip trades. Now, what's a round trip trade? A round trip trade for your broker is generally when you open and close in the same day. Now, that might be a very common thing for you to do, especially if you're an intraday trader, but if you're doing it, say for example, with a Forex broker who generally doesn't have these pattern day trading rules, that's a very different proposition than doing it with something like TD Ameritrade when you don't have a margin account. Now, why wouldn't a Forex broker have those pattern day trading rules? Well, generally Forex brokers allow people to have margin, right? So that is kind of the idea of pattern day trading. Now, there's also going to be some differences with, the brokers as well in terms of, how much of these trades make up of your account, all these kinds of things in terms of considerations for pattern day trading. So definitely read your broker's rules around pattern day trading, right? And as well, different brokers will have different responses to the pattern day trading. So like I said, I got grace from my broker, TD Ameritrade, because the rule is if you do it once, they basically put your account into margin call. It's not a real margin call, you need to bring money, but they're essentially saying that if you want to start trading again, either say you're a pattern day trader, if it's your first time, say you're not going to call us and tell us you're not going to do it again, and understand what it is that you did, and basically get this, they'll go through getting a hold off, and it's a very simple process. You literally just have to call them, the person on the phone will be able to see that, okay, it's a margin call because of pattern day trading, not because you're short a stock or anything like that, right? Or over leveraged or anything like that. So they'll, just kind of go through that, and if it's your first time, they'll just let you say, okay, well, you can go back to trading options, just make sure that you don't do pattern day trading again. Because essentially, if you do, what happens is they shut your account off from options trading until you get $25,000 in your account, right? Well, not all options trading, but essentially the only options trading that you can do in your account until you get $25,000 is basically a cash secured put or call, or a covered call as well. So that is the pattern day trading rule. It's a very, very important rule to understand as it pertains to day trade, especially if you're trading with things like TD Ameritrade, Interactive Brokers, things of that nature, right? So I hope you guys enjoyed this. Hope it provides some value to you guys, and join us next time, man. Thank you.